Everybody. Welcome to Grossman, Yannick and Ford's second webinar on loan forgiveness under the Paycheck Protection Program of the CARES Act that was enacted on March 27th, 2020. With respect to administration, before we get started, what you see on the slide is just some of the information that's on our website at www.gyf.com. If you've not read anything on there and you're interested in more information on any of the topics that we discussed on May 1st or that we will be discussing today, please feel free to go to our website. We're posting on there constantly with respect to the PPP program and the forgiveness developments as they occur, both by the SBA, the Treasury Department, and in addition, now Congress. I don't think that in my career in 4 decades, we've seen anything like this. And so we put a lot of attention to this topic in our firm on behalf of our contacts and clients and friends. And we want to share that with you today. My name is Robert Grossman. I am a founding partner of Grossman, Yannick and Ford. The co-presenters today are Don Johnston, my partner in the tax services group of Grossman, Yannick and Ford, who has very extensive experience in corporate and planning matters for both corporations and high net worth individuals. Also presenting today will be a senior manager from our tax services group, Mike Weber, who handles a great deal of corporate work and individual taxation on more complex matters as well. So the three of us, as well as other managers in our group and other professionals within our group, have been monitoring the developments with respect to this program for quite a while, since before the law was enacted on March 27th. As I said a moment ago, I've never seen anything quite like this, dating back 4 decades of tax bills that have come through Congress and across the sitting president's desk. This bill and this program was created, obviously, as everyone knows, to help smaller businesses weather the storm through this pandemic. And it's been incredibly successful and incredibly popular as interest in this is above anything that we've ever observed in our practice. We have approximately 500 attendees on today's call, shows the interest in the program. We first presented on this program back on May 1st with the thought of bringing people up to date on what was important in conjunction with filing for the forgiveness, because by that time, a great deal of the loan applications had been approved and monies had been moved out from the lender community to the user community, to the eligible borrower community. And so the next step, of course, is to make sure that the monies are utilized in a manner that optimizes the amount of loan forgiveness you can get under the program. When we did that program on May 1st, we were expecting to have the quote unquote final guidance. That was promulgated, if you will, in the statute itself, and they had 30 days to provide that. And of course, we didn't have that on May 1st. Point of truth, we got that guidance just last Friday. And in conjunction with that guidance, there's been other bills introduced in Congress which modify yet further the program as it sits. So what we'd like to do today is we're going to go through where things stand at this juncture, try to explain to you what we know is happening out in Congress and out in the area of technical developments that are going to affect your loan forgiveness calculations, and then move us forward from that point. I'm going to ask my partner, Don Johnston, if he has any opening comments before we get started.
Good morning, everyone. Just a couple very minor things. First off, if anybody, as we go through this, if you have any questions, there is a Q&A button in the middle of the screen towards the bottom. If you want to ask questions during the presentation, feel free to do that. With close to anywhere between 400 plus participants today, there's very high likelihood if we get too many questions, we're going to cover very few of them. But as we go through, if we can address things as we're talking about specific topics, we will definitely do that. And the way the program is set up is we're going to talk a little bit about what has gone on over the last month. We're going to talk about some of the changes, some of the very important documents or guidance that has come out of both SBA and Treasury over the last couple of weeks. And then we're going to spend a good bit of time towards the end, maybe 20 to 30 minutes, reviewing the application for forgiveness that was released on 2 weeks ago today, May 15th. That 11-page document, which includes the instructions, is very important. And there are a lot of moving parts. So, we'll refer to that document as we go through some of the background, some of the brief history, and then we'll review the application probably 60 minutes from now or something like that as we get closer to towards the end of the program. Back to you, Bob.
Thank you, Don. Well, and I guess, in conjunction with Don is saying, perhaps we were a little naive on May 1st thinking that we would have final guidance, but it's an interesting program. I think everyone on the call will agree in that people were out there borrowing substantial sums of money without any idea of how the forgiveness worked during the application process. What we found out in the month of May is that there's been an incredible amount of developments, and we want to start by first looking at where these loan programs are and how many people they're affecting, and then we'll move into some of those developments and talk about those technical developments that we're aware of at this time. I also, as I mentioned, there's congressional action in conjunction with what's going on here, and we just posted last evening a post to our website that addresses the flexibility of loan forgiveness requirements that was passed by the House of Representatives just yesterday. So we have some commentary on that at the back of the slides, but understand that as we thread through some of these more complex calculation methodologies, we're going to advise you where we know that tax bill will affect, or where that new bill will affect the rules as they now stand. And we'll give you what we think our prognosis is at the end for passage of those changes, because I think it is highly likely it's worth some time today. These loans have been, as I said, incredibly well accepted in the marketplace. I think everybody that felt that they could make the certifications on the application with respect to uncertainty and necessity in conjunction with borrowing the money went out and took some money. And that's what it was for. I mean, this program reflects a very positive effort by Congress to head off the downward economic ramifications of the pandemic and how it affected the economy with the closure. So it only makes sense that people would take advantage of this if Congress were able to act fast enough, and they certainly did. The problem is in acting quickly, as we all know, and doing something like this, it leaves a lot of room for interpretation, and you can't nail down every detail in conjunction with passing legislation at that level without some further guidance, and we've seen a lot of it. Right now, well, I shouldn't say right now because today is the 29th, but as of last Saturday's report, the SBA reports weekly, the loan count nationally was 4.4 million loans. The amount of money that had been loaned to date to last Saturday was $511 billion. Now, keep in mind, round one of these bills had $349 billion allocated to it, and it was quickly spent and ran out of money. There was another round two, as everybody on the phone call is probably aware of, which was another $310 billion. So the total allocated out of the federal budget for this loan program under the CARES Act was $659 billion. So that leaves approximately $150 billion left in this program for lending to potential eligible recipients post last Saturday. And so there are still monies there to be taken. The total lender count across the country that have been involved in this is 5,511. And the average loan size, we've read a lot of stories about people taking giant loans that maybe didn't need them, but the average loan size is only 115,503. So out of those 4.4 million loans, a ton of them have gotten to the right people to who the congressional leadership wanted them to go to.
Yeah, let me make a comment. Hey, Bob, let me
go ahead.
One comment. In the first round of this PPP loan program, there were many small businesses that didn't make it. They didn't get through in the first round, which is why they had a second round. And in the second round, a lot of my clients who are self-employed, people who have Schedule Cs, people who have small LLCs, a lot of those individual businesses were able to get loans in the second round. So the second round, did a huge benefit to a lot of small businesses. And where we saw some very small businesses having problems is when they were working with a bank that either didn't do SBA loans or weren't participating in a big degree with the PPP program. And in some situations, we had to have some of our smaller clients who are dealing with smaller banks go to different financial institutions to try to get this PPP loan. And the only problem with that is a lot of banks, if you're not already a customer, they're not able to, according to the regulations, to bring you in as a new customer just to do this PPP loan, because they have to do a lot of background work before they can even bring you in as a customer. So initially, the relationship that our clients had with our bankers were incredibly important. Those were you had a relationship with your bank. Oftentimes, that was able to help you push the application through. Go ahead, Bob.
Okay. You were breaking up there just a little bit. I just wanted you to know. No problem. The other thing that we have an interest in here, of course, since we service the tri-state area, is to look at the count across the 3 states that we service most often. And while we do work, nationally, most of our work is concentrated in these 3 areas. And you can see by the numbers that Pennsylvania's fared pretty well with $20 billion of loans and a loan count of 155,000 and an average size of 132,027. You'll recall from the other slide that the average nationally is 115. So Pennsylvanians have borrowed a little bit more. Ohio, even a little bit more than that with 129,000 loans. And then West Virginia, fewer loans, which has a little more of a rural feel to the state, seem to not get as many loans as I might have expected in the state, however. The tri-state area borrowings as a percentage of all the loans in the country, almost 8%. If you figure 3 states out of 50, that's 6%. So we've gotten our share in these 3 jurisdictions, these 3 states. And so that's the reason for the quandaries with respect to forgiveness and how best to do things. We have a lot of interest, as we've mentioned, the number of participants on the phone today. It's just the sheer number of people that have participated in this program have driven us to the point we're at today. So just quickly again, the PPP was a part of the SBA's traditional 7A loan program. It was instituted as part of the CARES Act, as we said. The program was legislated to be directed by the SBA. And that's an interesting point that needs to be understood as a borrower under this program, that the SBA is really running the show. And they are using, consultation with Treasury to add to their pronouncements and their frequently asked questions, but a lot of it's coming from traditional SBA literature and guidance for the old 7A loans, and they're kind of moving on a shifting base as fast as they can to pronounce legislation. Because of that, we've seen an incredible amount of information that's come out of the SBA since our May 1st presentation, and we're going to go through that as well. Obviously, as I mentioned earlier, as of that date already, we were ahead, we were behind on getting guidance on the May 1st presentation, and here we are 28 days later, just basically receiving it as well. So what we've seen, just to give you a quick overview of the pronouncements that have come out, because we want to move to more salient conversations, just to give you an idea of what we've been trying to deal with on our front, is April 30th, which was obviously 2 days before that last presentation, the IRS had released Notice 2020-32. That particular ruling had to deal with whether or not the expenses paid with PPP loan proceeds that were forgivable were deductible. Then on May 4th, they started releasing a dribble out effect of different FAQs, number 40 on May 4th, number 41 on May 4th, and on May 5th, they did number 43, which is applicable to us, the people on the call today. May 5th, in response to the notice that the IRS had released in April, on April 30th, the Senate introduced a Bill 3612, which is the Small Business Expense Act, meant to restore the deductibility of the expenses, and we'll talk about that a little bit more. May 13th, 46 was released in the interim final rules, basically talking about good faith certification and the necessity of the loan request in the first place. That was an important ruling, and we'll talk about that in a few minutes, because there was a lot of consternation with respect to the previously announced requirements. On May 15th, the loan application was finally introduced, and Don will go over that a little bit later, as well as a set of detailed instructions on how best to fill that out and complete it. On May 15th, again, there was another program introduced by a bipartisan members of the House of Representatives, which were meant to ease certain of the restrictions that we'll talk about today on obtaining loan forgiveness under the PPP program. And then finally, on May 22nd, which was what we were waiting for prior to the last seminar, the last webinar on May 1st, the final guidance relating to the loan forgiveness application approval process were released, as well as a second set of guidance that was intended to be used by SBA and in particular lenders as to what their responsibilities are in conjunction with reviewing applications for loan forgiveness. So you can see, I mean, you go through all of this and it's like stunning that there's almost a daily knockout of something that's released out of the program that affects, you know, you people on the call as borrowers, if you will, under this particular program. So with that in mind, we want to talk a few minutes about each of the bigger items that we think are of import, and I will, of course, invite my partner and Michael as well to join in if they have any comments to add along the way. The first is on the tax deductions itself. So IRS Notice 2020-32 is an important document because it provided a conclusion, a ruling, if you will, from the Internal Revenue Service that when payment of the business expenses are paid for from proceeds that were forgiven in the PPP loans, those business expenses will not be deductible. That was not discussed in the original CARES Act in the legislation. It was a question that was posed by many people to our team leading up to the release of this notice. This is the outcome that we would have expected, only because economically you pay $1 million of expenses with $1 million of loan that's forgiven. You really haven't spent any of your own money. So why would you be entitled to a deduction? And I think, you know, there's a code section that talks about tax exempt income with the idea that expenses associated with tax exempt income are not deductible. And that's common throughout the Internal Revenue Code and the citations on the slide. But suffice to say that a lot of people have taken issue and umbrage with this particular decision by the IRS. And so the issue of whether or not you get a tax deduction remains a little bit fluid. The law as it sits today is that you will get no tax deduction. From a federal tax perspective, you're not going to have much chance of winning an issue of deducting these expenses when that ruling is out there, unless there's congressional action. And as you might suppose, of course, there is congressional action. So Grassley, Senator Grassley in the Senate Finance Committee took great umbrage, as I said, with respect to that decision by the IRS. And so he introduced a bill on May 5th, Senate Bill 3612, which was just 5 days after 2020-32 was released. And this bill basically, if enacted, would allow that the expenses that would otherwise be deductible under Section 162, that's simply just trade or business expenses. So if your payment of covered payroll and covered non-payroll expenses, rent, mortgage interest, et cetera, would otherwise be deductible under other sections of the Internal Revenue Code, then even if the loan is forgiven, you will get a tax deduction. That's a very substantial decision by Grassley to introduce this. It goes against what I think most tax practitioners would see as a reasonable application of the code as it's fashioned. But these are not normal times, and I think, you know, Senator Grassley, as well as others that participated in the construction of the CARES Act, essentially said that it was never their intent that these deductions not be allowed. So that's, you know, up for debate, but not necessary to discuss in a call like this today. The problem with this bill is it was introduced on May 5th, as we said. It does allow the deduction, but it hasn't really moved out of the Senate Finance Committee in 24 days. It continues to sit there. So whether they move forward with this is a question in our mind at this time. But our position is, and I think the law as it's currently enacted certainly says that if to the extent that your PPP loan is forgiven, the expenses that you pay out of those proceeds will not be deductible under the current law. I would also add real quickly that they're not going to be deductible for Pennsylvania purposes as well. I don't think West Virginia either. And I haven't really researched all three of those states really carefully, but it's not unusual that you have states decoupling from federal incentives just because of the hit it puts on the state budgets in those states. So there will be oddities, if you will, if this isn't changed between your returns filed for federal income tax purposes for 2020 and the amounts that are paid for your state tax returns. Let's talk about FAQ 40. FAQ 40 basically is a protective device for you as employer borrowers in that it allows you to exclude employees who have been recalled to work but have refused to do so. That's something that I have to say I really didn't expect at the beginning, but if you see the amounts of unemployment that are funded and so forth through the federal program, in addition to the state unemployment, what we've observed is that we have a lot of laid off employees or furloughed employees that are making more money now than they were working. And so there's a reticence on their part to return to work for understandable reasons. So that's all that this is about. If you follow these rules that are on the slide, and I don't want to waste time going through them because we have other more important things to do, just understand that there's a formal process to asking your employees to come back to work, and that you need to observe that process to make sure that you can exclude the impact of these people not returning in your loan forgiveness applications. There is a warning in this that I think is wise, is a smart move from the SBA, that employees who refuse to come back to work, they will be banned from receiving unemployment benefits if they turn down a reemployment offer that follows the protocols in this particular FAQ. FAQ 41, another development on May 4th since our last discussion together. This just basically provides certification requirements for seasonal employers, and indicates that you can make all the certifications that are required on the application form if you use an alternative period. This is very specific. Again, I don't want to spend a lot of time on it today to make sure that we have plenty of time for Dawn and Michael, and that we get through the material. But understand that that's out there. It is important if it applies to you. FAQ 43 and kicking back to 31, which was pre-May 1st FAQ 31, but FAQ 43 basically references the earlier one. So this was issued on May 5th by the SBA, extended the safe harbor deadline for returning amounts borrowed under the PPP loans from the original return date of May 7th to May 14th. And the beauty of this, Dawn and I often laugh, I mean, the deadline was May 7th, and they ruled that they're going to push it back a week on May 5th. So there was a lot of troubling effects of this FAQ 31. And the reason FAQ 31 was released is because the stories you read about the Ruths, Chris, and Harvard and some of these other institutions borrowing money under this program, under the certification requirements that were out there originally. So FAQ 31 is basically issued in response to what the SBA observed as maybe not totally honest certifications. And it made it clear that the SBA is going to require companies applying for the loans in the second round and forward to certify in good faith, not that there was uncertainty, which was what the legal requirement was in the first round, but that the funding was necessary to continue moving forward through the government mandated shutdown of those funds. So if you did not have the certification requirements made in good faith, if you felt that maybe you were just being cautious and your circumstances don't demonstrate a real need for those monies, then you expose yourself to this lack of good faith certification, in which case the SBA and the lender would have ruled, or theoretically could have ruled, that you did not qualify for the loan. And if you did not qualify for the loan, then none of it is forgivable. So as an outgrowth of FAQ 31, the borrowers were given a deadline to return the funds if they reevaluated their certification. And I assure you, I had many clients that we talked about that ad nauseum because they were some of the fortunate companies that were able to move forward without a lot of economic impact. Nevertheless, that uncertainty at the date of application in the first round should be the guiding literature in conjunction with a future examination, if you will. So all the 43 did was extend that date to return the funds from May 7th to May 14th. 31, though, was the big thing that caused a lot of problems until they cleared that up this month as well. Basically reminding borrowers that the certification had to be made in good faith, taking into account their current business activity and their ability to access other sources of liquidity sufficient to support ongoing operations in light of the pandemic shutdowns. I mean, the reality is that these were not specific requirements in round one. And so I think most practitioners felt, clearly we felt, that there was no legal risk in conjunction with this. It was just a matter of whether or not the loan would qualify with respect to the necessity requirement. And so that was caused a lot of pain for the first part of May. But then they came out with this FAQ 46 on May 13th, and this was a very important decision for you as borrowers. And basically, it reduced the overall SBA, IRS, or Treasury audit risk by providing essentially a safe harbor for employer borrowers that receive PPP loans with an original principal amount, original proceeds of less than $2 million. So basically, what they're saying in this frequently asked question, this FAQ, is that those loans will be found to have been made in good faith. And so that particular element of having the loan forgiveness challenged by the lender at a later date or the SBA goes away. And so that's important. And that protects almost everybody who borrowed a loan under $2 million. And obviously a very positive development. It did not provide that same safe harbor for loans of $2 million or more. However, it does provide that borrowers may still be found to have an adequate basis for requiring the loan proceeds, and that certification would have been made in good faith based on their individual circumstances. But that's going to require being addressed, if you will, at a later date, possibly by the SBA in conjunction with their reviews of these loans. But it is important. It also notes and gives some relief, if you will, to larger borrowers by suggesting that if you're found to lack adequate basis for your certification in the first place, then it's simply going to seek repayment of the loan proceeds, set it up as a loan, and it will be paid off over a certain amount of time. And if you pay it off and take it as a loan, if it's found not to be forgivable, they're not going to basically assess any penalties or turn you over as a borrower to other agencies within the federal government. So it's kind of a good thing. It takes away a lot of the risk of the certification. And I can't tell you how many questions we answered at our firm in conjunction with people being concerned about these certification requirements. FAQ 46 is a positive announcement, as the slide says, and clearly a win for the borrowers under these programs, both large and small borrowers. Those are the overall big developments. We want to turn now a little bit to the calculation methodologies that we know right now, because obviously the forgiveness is what we're talking about, and obviously one of the most attractive elements of this entire program is having these funds put into your business or organization, and then having the ability to have them forgiven. So the mechanics of the calculation to now focus primarily on the overall approach of maintaining jobs. It was Congress's intent, we spoke about this last time, to make sure that these people's jobs are maintained, and if they are, you could use PPP monies, government funds, to pay these qualified wages and salaries and certain expenses through a certain period of time, which was basically running in conjunction with the pandemic shutdowns. So it was meant to maintain employment and keep those people off of the unemployment rolls. Interestingly, with the number of dollars that you've seen kicked out there and the number of people that are on unemployment in the United States, it's stunning that many people are still on unemployment, and this $500 billion has been moved out already. in the marketplace to try to preserve those jobs. It shows, I think, the severity, if you will, of just how detrimental and how difficult it has been for a lot of companies and businesses throughout this entire process. Key elements of the loan forgiveness. Under the current law, not more than 25% of the loan forgiveness is used for non-payroll costs. And everybody's been working with that 75-25 threshold since the beginning. Well, not since the actual act, because the SBA set the 75% threshold because it felt that it forced borrowers to comply with the overall intent of the law. That was, of course, to preserve the jobs, as I just mentioned. Note that in the legislation that was passed yesterday by the House and is likely to proceed, that number's moved to 40%. So that's a kind of a radical change that people probably have not been planning for, but that has been pushed by business lobbying groups, borrower, employer groups, etc. And so it looks like that may be changed. The employee headcount, as long as you maintain the employee headcount and maintain that, and there are some changes in that as well that Dawn will talk about as we get through those. As long as compensation levels for employees earning less than $100,000 are maintained, Michael's going to talk a little bit about those. And then Michael will also address this idea that on the guidance that came out last Friday, that there is a protection device in there from being penalized in the amount of your loan proceeds that qualify for loan forgiveness for both FTE reductions, full-time employee reductions, and wage reductions. I mean, it stands to reason, right, that if your headcount drops, your wages are going to drop theoretically. So there's a provision in the final rules that came out that Michael will address that we'll get into those in a couple of minutes. So we went over this the last time we were together, so we'll cover it relatively quickly so that you know where we're going to be heading through the calculation, because I think it's important. And I think the importance of understanding where we're going from a theoretical or technical aspect as we go through these next slides will then be borne out in what information Dawn shares with you with respect to the application. So the CARES Act, there's two primary provisions in the actual law that was passed on March 27th, 1102 and 1106. 1102 was the rules to get the loan. 1106 was the rules to have the loan forgiven. So basically the language is an eligible recipient, which is you, if you've already received a loan, are eligible for forgiveness of indebtedness on a covered loan. That's the PPP loan itself, in an amount equal to the sum of the following costs incurred and payments made during the covered period. Now the terminology on the slide in red remains critical. It was critical when we spoke last time, and it's important again to go forward understanding what those terms mean. So the costs that you can spend the PPP proceeds on are payroll costs, interest on covered mortgage obligations. You can't have any prepayments or principal, any payment on any covered rent obligation, and any covered utility payment. So these were right out of the law, and there's been a little bit of clarification provided on a couple of these items as we've moved forward, but not a lot of detail has been expressed, especially on the non-payroll costs. The covered loan is again simply the PPP loan. The covered mortgage obligation, that's any indebtedness on a debt instrument incurred in the ordinary course of business that, one, is a liability to you as the borrower, is a mortgage on a real or personal property, and was incurred before February 15th. So they're not looking for new borrowings on which you're going to allow interest from other sources. But if you had a traditional mortgage or a lien on real or personal property, then that interest is going to be deductible. And that's the answer to that question, is what covered mortgage. Covered rent, on the other hand, was originally just rent payments, as you see here. Any covered rent obligation, but that was later clarified on May 15, 2020 in the loan forgiveness application instructions, that when they're talking about rent, they're talking about rent or lease payments for both real and personal property. So our interpretation of that, our team, is that, that includes leases on copiers, vehicles, whatever you're using in your business, that is an expense that's paid for through the rent deductions. Covered utilities is another area that we've seen a lot of questions on. And unfortunately, through all of these pronouncements, all these FAQs and further guidance announcements that have been made over the last 30 days and even, through the month of April back to the date of the act itself, there really has been no change or clarification in any of these numbers or any of these terms. So the utility payment is defined as a payment for the service of the distribution of electricity, gas, water, transportation, telephone, or internet, as long as that service for which you're paying was started before February 15th. So, the fact that there's no guidance on there leaves room, and we've had a number of questions about particulars within this definition, especially transportation, and whether things like gasoline qualify. We think it does, for example, in that term. Parking, I don't know if we have as definitive an answer for employee parking if you pay employee parking. But those are the kind of things that are allowed to be deducted there. It's going to take a little bit of latitude and a little bit of creativity when you're filling out your application to be as close as you can to this terminology and building support for your argument that something other than the actual specifically listed items qualify as a covered utility payment. Talk about the covered period in 1106 that starts out, and this has been a huge issue of controversy and discussion from day one. Basically, it's 56 days, an 8-week period, and what we knew until very recently is that it began on the date of origination of the loan, the date that the monies were actually moved from the lender into your bank account. That was day one. And it ended 56 days later. The instructions to the loan forgiveness application, which came out on May 15th, introduced a totally new concept, which was an alternative payroll covered period. And I think a lot of people were struggling with the administration of the payroll period itself. And so the alternative payroll covered period is still a 56-day, 8-week period, but it doesn't begin on the date of the loan origination or the date that the proceeds were transferred to your account. So for employers and borrowers of these loans that had a biweekly or more frequent payroll period, you were able to choose or able to elect in making your calculations for loan forgiveness, starting with the day on which you have the first pay period following the PPP loan disbursement date. So you take that loan disbursement date, pick a date, May 20th, and you have payroll on May 23rd, you can use the May 23rd date as the start of the 8-week period instead of May 20th. And that's an important distinction from where it was in the past. It's still an 8-week period. Dawn, did you want to make a comment? I know that you've observed some people talking about the capability of getting more than 56 days of payroll by dealing with this alternative payroll period.
Yeah, and what I'll say here is the latest interim guidance, the interim final rule that came out just a couple days ago, number 32, addressed and defined a section that says paid and incurred. But that doesn't mean, in my opinion, that doesn't mean it has to be paid and incurred. It can be paid and it can be incurred. So there are a lot of people who think that you can use the cash basis for the payment at the beginning of the process, i.e. I received my loan today and my payroll, and actually pay people tomorrow. So I'm paying people tomorrow for the last 2 weeks. So the interpretation there is that since you paid it, you can include that payroll. And then when you get to the end of the 8-week period, anything that's incurred but not yet paid can also be included. So it's possible that you can actually include up to possibly 10 weeks of payroll, depending upon where your payroll periods fall and when you receive the cash. And that guidance seems to indicate, and I've read a lot about it, and a lot of commentators are in the same boat as I am as far as interpreting it in that way. And I haven't seen anything to come out yet, and maybe we'll get some guidance that makes it more clear whether you're really able to use 10 weeks of payroll just because, because of the timing of when you paid a payroll and when you got the money. So it's something that at this point it's still a little bit unclear, but the guidance seems to say that you're able to include in some cases more than 8 weeks of payroll.
Yeah, I think that's an issue that still needs some clarification, and it might be an issue that completely disappears because we talk about this covered period and the alternative payroll covered period being 8 weeks or 56 days. The legislation passed by the House yesterday expands that to 24 weeks. So it's 3 times as long. So the idea that you're going to need to make difficult decisions on when to do your cutoffs on payroll should disappear if you use the proceeds. If that law proceeds to passage, this kind of an issue completely goes away. So, but we wanted to bring it out because as the law is today, clearly that's a planning opportunity to take a look at and see if you're interested in that.
Yeah, and Bob, just timing of when this thing's going to make it through the Senate, and like you said, the House passed the bill last night, with basically bipartisan support, and now it makes its way through the Senate. So we have to believe that something is coming relatively soon. And I know I have clients whose whose 8 week period is going to end probably sometime next week. So a lot of people are towards the end. So we kind of need to have these rules before that 8 week period because it's going to change. Potentially, it's going to change how you would do things and how you would make payments towards the end.
Yeah, that's a good point. And we'll talk about the prognosis for the bill. I agree with Don. I think the chances of a bill expanding all of these requirements, and we'll get into exactly what we mean by all of these, is more likely than not. The Senate is very supportive of this. The vote yesterday was 417-1. The president wants this. The Senate is obviously Republican. I would be very surprised if we didn't see legislation by the end of next week. There is some differences that we'll talk about between the House bill and what the Senate's arguing, but they're the kind of things that can be hashed out in a compromise meeting and having that done. Let's talk about the other steps that are there, because we're going to get into this step 1 under the calculation, because even if they expand the covered period, et cetera, there's still going to be this mathematical calculation that you're going to have to demonstrate at the end of the day. The eligible recipient is the borrowers, of course. The expected forgiveness amount are the same as the original amounts, so you have that we just talked about before, so we don't have to spend time going over this. Now you have to get into the definition of what payroll costs are. And payroll costs are defined in both code sections of the Act, 1102 and 1106, the same. The amount for determining the loan and then on the other side. So there are salaries, wages, commissions, or tips, capped at $100,000 annually. I think everybody is probably familiar with that. Employee benefits, including costs for vacation, parental, family, medical or sick leave, allowance for separation or dismissal, payments to provide group health insurance benefits, including insurance premiums and payments for any retirement benefits. We've got a variety of questions on healthcare benefits, and there's a lot of nuances to that. We have employers that pay for healthcare benefits for their employees. That certainly would count. We have people that help pay part of the deductible for the employees. We consider that to be, the kind of thing that they're talking about here as well. You need to read this with a little bit of interpretation. Employers that pay drug deductibles for people that need prescriptions, et cetera. I think all of that would fall into this salary, wages, and commissions. State and local taxes assessed on comp. If you happen to be operating in a jurisdiction which is assessing the employer a tax on compensation paid, then of course that would be included as well. And then for sole proprietor or independent contractor, basically the items that you see there, looking primarily at net earnings from self-employment income capped at $100,000. So that's what we see as being in there. Something that's new that's added on May 22nd, and we were told in the original legislation and what we interpreted early on from discussions with commentators and our review and research associated with this, that the wages that were paid in the 8 week period had to parallel the wages that were paid, if you will, the payroll that was paid in the test period of the prior year, et cetera. And that basically could have excluded things like bonuses, hazard pay, et cetera. But they've come out and ruled on May 22nd in the final guidance last week that in addition to that previous definition of payroll costs, you can include bonuses, you can include hazard pay, and you can include any of those amounts that are described under payroll, any similar amounts that you pay to furloughed employees as part of the payroll cost computation for loan forgiveness. So that's not unimportant. It makes perfect sense that if you're bringing people back into a hazardous situation, you want to give them extra to come back, or bonuses for coming back and starting up again. That should be included. That only makes sense to us, but it's clarified now and was not before. So keep that in mind as you're applying for loan forgiveness. Payroll costs do not include payments made to an independent contractor. That contractor, as indicated on the earlier slide, could go for his or her own PPP loan. Any adjustments to gross wages, either up or down for federal payroll taxes, including the employer's share of FICA taxes. So that's unusual in context in that, in our minds, an employer payroll tax is part of payroll, but it's statutorily excluded and not included in there. We've also got a lot of questions on unemployment compensation, which is not set up there as well on the slide. We don't have a definitive answer to that, but I think it would be excludable on the basis that there are a lot of payroll-related costs that are associated with bringing employees back. But I think it's safer to basically follow the statutes and stick as close as you can to the verbiage in the statutes to protect further scrutiny later on when your application is being reviewed. Payroll costs do include, obviously, payments made to general active partners as well. So we're going to talk about how the calculation is made, and you'll be interested that it varies slightly from what we thought it would on May 1st. It gets you to the same end, but as we go through this calculation, and as Dawn brings up the application itself and goes through the mechanics of the application, you'll see that this has a flow that goes exactly down the application, and it's not very substantive. I'll save the discussion on that for Dawn. So basically, your starting point is to determine the period, the date that the covered period begins. Right now, again, that covered period is 8 weeks, but likely to be expanded. And you either choose your covered period or your alternative covered period, as we just discussed for payroll. And you move from there. The AICPA had introduced recommendations for that, those two that you see right there. And they did adopt the AICPA's adoption that you should align with the beginning of a pay period. That's what the alternative period is. So let me just real quickly go over step one. This is a very basic fundamental aspect of loan forgiveness in the application process. If you borrow $500,000, if you borrow $1 million, the first step to getting loan forgiveness on 100% of it is you have to spend you have to spend $1 million on qualified expenses, on covered expenses. So you have covered payroll and you have covered non-payroll expenses, and we've just gone through those. So the first step, obviously, is you got to spend the whole shabill and make sure that that gets paid. So in this example, if you assume that company A incurs and pays $850,000 of covered expenses, then that gap between the loan proceeds of $1 million and the $150 do not qualify for forgiveness. Ultimately, that will be set up as a loan and have to be paid back. So I'll turn it over to Don. He'll go through the aspects of maintaining the employee levels and through step two of the process.
Yeah, so step two of the process, and like Bob said, step one was paying the amount of the loan for covered costs. Step two, which is maintaining your FTE levels, and I'll talk about maintaining the FTE levels. Step three, Michael will talk about, is maintaining salary levels. And then step four is a 75%, 25% test, which we'll address. And then step five is applying for the application. So remember, in step two, remember what the original intent was of this PPP program. The original intent was to keep employees off of unemployment. And as a result of that, you know, they set up the PPP program, loan money to employers, and set it up so these loans can be forgiven. But they can only be forgiven if you're keeping your employees. And that's why there's an FTE test to determine whether you kept the employees that you had. So there are a couple different periods that have to be looked at. Obviously, the base period or the covered period, the 8-week period has to be looked at. So what they're going to look at is how many employees did you have during the 8-week period. So the 8-week period starts when you get your money, and then it ends obviously 56 days later. So let's assume you have 10 employees during that covered period. They're going to look at how many employees you had previous to COVID-19, before COVID-19. There are 2 different dates that you can look at to do your base period. And so what this formula shows, and those of you who are on the original webcast a couple weeks ago, I had the same formula in here. I'm gonna review it again. But basically you have 2 different options when you're doing this test. So you take the 2 different formulas. The numerator is the number of full-time equivalents you have during the 8-week period. You have 2 different options as far as the denominator is concerned. You either look at the period from February 15th, 2019 through June 30th of 2019, or alternatively, in the second formula you have here at the bottom, you would look at the total full-time equivalents during the period from January 1st of 2020 through February 29th of 2020. You're going to pick, of those 2 different options, on the denominator, you're going to pick the lower amount. So, Bob, go to the next slide. So for example, if during the 8-week period I had 100 full-time equivalent employees, and during the first test period I had 98. So basically I increased the number of employees. So my ratio was 100%. I did not decrease the number of employees. The second test is, you do the same calculation. You have 100 employees during the 8-week period, and then you look at the other base period. And in the example, the other base period would be January 1st through February of 2020. And let's assume I had 104 employees at that point. That ratio is 96%. So I get to choose the ratio that gives me the better option. And in this case, it's 100%. And since I have more employees during the covered period than I had during the base period, then I have no reduction to my forgivable amount as a result of my full-time equivalency test. I've had a lot of questions on this because when you look at the rules and you look at the instructions on how to calculate this, there are a lot of moving parts here. If you see from the next slide, I have a little example set up here that kind of walks you through it. And let me read the second bullet point because I think it's important. So when you're doing the test, you have to look at the average number of full-time equivalent employees by calculating the average number of hours worked by each employee on a weekly basis. And the average over the period is divided by 40 to determine the full-time equivalency ratio. For this test, an employee is considered full-time if they work 40 hours or more in a given week. So the way the example is, the first section here, I'm talking about the covered hours, the covered period hours. That's the 8-week period. So I have an employee, a single employee, as you can see there, work 35, 40, 40, 60, 30, 30, 35. That totals 300 total hours. That 300 total hours, you divide it by the number of weeks, and that gives you the average hours per week, which is 37.5. You divide that by 40 hours, so the full-time equivalency for this individual employee would be 0.9. Okay, so the first thing is, should I be concerned that it's less than 1? Does that automatically mean that part of my loan, it will not be forgiven? And the answer to that is no. And because what you have to do is you have to compare the covered period to the base period, okay? And the second section here, the selected base period hours, you can see that I have some hours across the screen here, and that totals 264 divided by 8. 33 is 33 divided by 40, so it's 0.8. Okay, so the fact that it's less than 1 doesn't matter. What's important here is, where did you start? You started at 0.8. At 0.8, it wasn't somebody who worked at least 40 hours per week. It's less than 1, it's 0.8, but you ended at 0.9. So the fact that the ratio is higher is a good thing, meaning that you had more full-time equivalents than you did at the beginning. Okay, so what you have to do is, for every employee, you have to look at the total hours over the 2 test periods to determine the change in your FTEs. So if you have 100 employees, obviously you've got some work to do. Hopefully you can just go through the payroll system and produce those hours and set up a formula within the payroll system to show the total hours during specific periods. And like I said, it's important because I got this question this week. We have a not-for-profit client where the average number of hours per person is only 32 hours per week. So the question was, are we gonna be in trouble here because we don't have anybody who's technically a full-time equivalent? But the important part to consider here is it doesn't matter whether you're full-time equivalent, i.e. 40 hours a week. What matters is the change from where you were before COVID-19 and where you land now. So, I've seen different schedules that set up here to track something like this. And obviously, like I said, there are different periods that you can choose from. So, the calculation of the FTEs is something that is going to take some time, especially looking back over, in one case, it's 2019 hours, and in another case, it's 2020 hours, and you're gonna choose the better option. There is a simplified method, which I have right in the middle of the screen, says simplified method. And basically the simplified method, the way that works is, anybody who's less than 40 hours, you can just automatically assign them a 0.5. So instead of having like a 0.7, a 0.9, a 0.4, you just automatically, anybody under 40 hours is automatically a 0.5. And when I would say that you do that is in that situation that I gave you, where everybody on staff works 32 hours a week. Well, if everybody is 32 hours a week, you assign everybody a 0.5. If the before is 0.5 and the after is 0.5, you add everything up and your full-time equivalents don't change. So, I'm beating this a little bit, but this is an important point because knowing that some of the rules that we have right now may change going forward, the full-time equivalency is probably to some degree going to stay in the law, and you're going to have to figure out what your full-time equivalents are, because at the end of the day, they wanted you to keep as many employees on staff as possible. Next slide, Bob. So this, I'll hand it over to Mike, and I'll talk a little bit more about the FTE calculations when I show you the application later in the program.
Okay, thanks, Dawn. One just very brief housekeeping item. We're obviously monitoring all the questions that are coming in, and to the extent we can't answer the questions during the webinar, of course, we'll be reaching out to people. But we're getting a ton of questions from quote-unquote anonymous attendees. So if you don't hear your question answered, please, since we can't identify specifically who you are, please reach out to one of the speakers here. We will get your question answered. Okay, as mentioned numerous times throughout this presentation, there's various steps to this process. This, of course, is step 3. I thought that it would be very easy at the outset to understand whether you reduce somebody's salary or wage from what they were previously making to what they're making during the covered period. But of course, the CARES Act and the original guidance went at great lengths to gum that up and make it about as confusing as it could possibly be. Now, the latest guidance does clarify to some degree how you're going to calculate whether you reduce somebody's salary or wage. And I do have the specific language in the latest guidance listed in blue there. And one of the things that they've notated now is this idea that you're measuring your base compensation against the January 1st, 2020 through March 31st, 2020 period. They call that the reference period. Of course, there are various exceptions to cutting somebody's salary or wage. But one thing that I'll point out, and that was clarified numerous times now, is that this application of determining whether you've reduced somebody's salary or wage is to be applied on an employee by employee basis and not in the aggregate. So there was some thought by some people at the beginning was, well, my total payroll was X and now my total payroll is Y, and that's what I'm comparing. Well, that's not really what you're comparing. You're comparing, employee A versus employee A after the fact, employee B after the fact. So you have to consistently apply this methodology across each employee. I have a very, very easy and simple example here on the next slide. And I threw the full-time equivalency numbers in here at 1 just to make things very simple, as Dawn has mentioned how to calculate those things. But if you had an employee that was making a weekly salary of $1,000 a week, and during that reference period, and then you reduce that employee's wage to $700 a week, I think everybody could easily see there that you've reduced that person's wage by $300 per week or 30%. Of course, we know, based upon the 25% reduction rule, that the first $250 is exempted from the reduction calculation. However, that $50 that's left over, of course, is the amount you're going to reduce your loan forgiveness by, and you're going to multiply that by 8 weeks, which is the covered period or alternative covered period. The idea right now being the 8 weeks. So the $50 times 8 weeks will land you at $400. Okay, next slide. This is one thing I'll take a couple minutes to talk about here because, well, first of all, we've mentioned it several times on here on this webinar. We've mentioned in the past there has been a lot of confusion with respect to if you reduce somebody's hours, are you also reducing the amount of money that you pay them? Yes and no. I guess nominally for that specific person, yes. Are they making less in a week? Sure, but has their rate changed? Has their rate per hour or their salary per hour changed? And as long as your rate per hour, I'll just call it that for right now, is not reduced, even though your hours were reduced, you're not going to have to reduce your loan forgiveness amount by the drop in the amount of payroll that you have for that specific person. Now, that doesn't have anything to do with the FTE reduction or how that's to be calculated, but you will not have to reduce your loan forgiveness amount by any number if all you're doing is reducing somebody's hours and keeping them at the same equivalent salary or wage. And I know that was something that was a very big question way back from the very beginning. How do these two things interact with each other? And the latest guidance clarifies the answer to that question. Okay, next slide. So you can see here, I have, again, a very basic example here. If you have an hourly wage employee that had been working 40 hours a week during the reference period, but the borrower, you, reduced the employee's hours to 20 hours per week, and now they become a 0.5 FTE. What's the ramification of this? Okay, as mentioned, there may be a ramification for your FTE calculation, but there's not going to be a ramification for the reduction in the amount of money that you pay to this person as long as you keep them at the same hourly wage or rate of pay. Okay, next slide. And this is my final slide. And this is another question that we've received during the previous webinar, another webinar I've done, and I've seen this question come up in our Q&A already, and many of our clients and contacts are reaching out. And again, this is something that may change moving forward, again, with the legislation that's out there. But I just wanted to give everybody the actual language out there right now on the restoration of your full-time equivalents or the restoration of the wage reduction that may have occurred during the period starting on February 15th and ending on April 26th. If you've, reduced your FTEs or reduced somebody's wage, you have an opportunity to cure that. Okay, now the language in here does say you can eliminate those reductions by June 30th, 2020 or earlier. So if you do that, by that specific date or earlier, it seems that you're not going to run afoul of these rules, and that your loan forgiveness will not be reduced as long as you, again, cure whatever happened between those two dates, February 15th and April 26th, by June 30th or earlier. Again, the legislation that's out there, I've seen at one point does extend that all the way to December 30th or December 31st, that you have the opportunity to cure it by then. I think this might be one of the areas where we need a further guidance to understand exactly what this means, but the specific language right now does say by June 30th, 2020 or earlier. With that, I'll turn it back over.
Thank you, Mike. The last step then, before the actual process, which Don is going to go through with you folks, is the application of the 75-25 rule and trying to understand if you've spent the proceeds in the proper manner as directed under the CARES Act and later SBA guidance. As I said, SBA was assigned the responsibility of overseeing this particular program, and so they are the parties, the ones that determined that 75% of the proceeds should be utilized for payroll-related expenses. That is not part of the CARES Act or the original legislation, nor has it been addressed in any other legislation that has come along until yesterday. So that's an interesting thing, and we've spent a considerable amount of time with clients and contacts trying to figure out exactly what fits into these two categories of expenses to make sure that we, spend 75% of the proceeds in the right way. So that's really what we're talking about when we look at the 75-25 rule. And so ultimately, the step is to confirm that at least 75% of the covered costs are used for payroll-related expenditures. And again, that was mandated by SBA with the purpose of facilitating what they felt was the intent of the legislation and the program in the first place. So the calculation itself is performed on line 10 of the application. It's the last step instead of the first step. We had thought that would be reasonable to apply at the front of the calculation. There was no absolute guidance on it. We know now that it's actually page 10. It's the last step, line 10 of the application, and the last step in determining the amount of potential loan forgiveness amount. So again, very simple example before Dawn takes over. Company A borrows $1 million. They incur $850 of total covered costs. That's the amount that's going to be potentially forgivable. The other $150 is going to be set up as a loan, as we talked about in step one. The payroll costs that have been paid and incurred total $595. So the way the calculation actually works is they take a look at the maximum amount of forgiveness being $793,000, and they do that by virtue of dividing 595 by the 75% requirement percentage. So 206,667 is required to be paid over the loan period, and only 793 will be forgiven. Remember, that's a difference between the 793 and the 850 because the 150 wasn't deductible anyway. So it's 56,000 of additional loan proceeds that will not be forgiven and added to the amounts that must be repaid. So what we're going to do here is make a technological switch. I'm going to stop sharing my screen, and Dawn's going to share the application with you and go through the application so that you can take a look at it.
Hey, Bob, can you hear me now? Hello?
Yes, I can hear you.
Yeah, I can hear you, Dawn.
Okay, sorry about that.
Screen.
Sorry about that. Okay, so let me get back to page one here. Okay, Okay, so this is the application. I'm going to go through this. I'm going to assume that very few people, if any, have really detailed reviewed this. This application it's 11, including instructions, it's 11 pages. But of the actual forms, there's only 3 to 4 pages of actual forms. The rest of it are instructions. Okay, so basically what we have on the very first page, and you can see my cursor here. So first 2 pages are just general instructions, and then it goes into the form. So let me show you what the actual forms look like. So first 2 pages are general instructions. Page 3 is the first form of the application. This is the PPP loan forgiveness calculation form. I'll go through this. Next page is a section representations and certifications that need to be signed by the borrower. Page 5, more instructions, and these are instructions for PPP Schedule A. Then page 6, this is PPP Schedule A, and you'll note that PPP Schedule A are the payroll costs. Okay, this schedule only includes payroll costs, and I'll go through that. Pages 7 and 8 are general instructions for the PPP Schedule A worksheet. So let me go down. So here's the PPP Schedule A worksheet, and this is where you report your employee payroll and full-time equivalency calculations, and I'll get back to this in a second. Page 10, some general instructions regarding what you must submit to the to your lender, to the bank. And then the last page 11 of 11, this is some optional information regarding borrower demographics. So let me go back up to the very beginning. Okay, very first page of the instructions. Let me make this a little bit bigger. Okay, very first page of the instructions. Whoops. I'm not going to go through any of these definitions. These are very similar to what Bob has already reviewed, so I'm not going to go through any of those instructions or the definitions. Let me talk about this paragraph right here, and I've highlighted some important parts. This application has the following components. Number 1, the PPP loan forgiveness calculation form. Number 2, the PPP Schedule A. Number 3, the PPP Schedule A worksheet. And 4, the optional PPP borrower demographic information form. It's important to note that all borrowers must submit number 1 and number 2 to the lender. So from a application point of view, there's not a whole lot that needs to be sent to the lender, but there is quite a bit of support that has to be attached to that information. Okay, so as we found through here, just a couple important things here. And I highlighted a couple things here. So let's go right to the application itself, and then I'll refer to some of the other things as we go through. So this is the PPP loan forgiveness calculation form. We have some generic information, general information about the borrower. I've highlighted a couple important points here. This line here, the PPP loan amount. This is the total amount of the loan that was received. PPP loan disbursement date. This is the day you received the funds from the lender, which in my example is April 20th of 2020. There's a line here that says employees at the time of the loan application, employees at the time of the forgiveness application. This has nothing to do with your full-time equivalency the full-time equivalency test. It's just general information regarding the number of employees you have. If you have an EIDL loan advance amount, which would be $10,000, that would go here. And you'd have to put your application for your EIDL loan here. Okay, payroll schedule. You're telling them what payroll period you're going to use or what payroll period you use, and that way they'll know what type of payroll period they should be looking for when they test your payroll. In this situation, I have it checked as biweekly. The covered period. This is your 8-week period according to how the law is currently written. And you can see that this 420 needs to agree to the loan disbursement date. These two dates need to be the same. And then the end of the 56-day period would be June 14th in this example. Alternative payroll covered period, since I didn't use it for my example, I didn't check this box, right? I didn't include the information there. There's a question that says, if the borrower, and this is important, together with affiliates, receive PPP loans in excess of $2 million, you need to check this box. Okay, so if you have 4 companies and you're you have 4 companies that are affiliated, and in total it's over $2 million, the total combined loans, you have to check that box. Okay, so let's get down into some of the calculations. Okay, so the first 4 lines, payroll and non-payroll costs. As you can see, these are the covered costs. Bob discussed and talked about what the covered costs are. As we know, it's payroll costs, mortgage interest, business rent and lease payments, and business utility payments. So these are my total covered costs, okay? Line 1, the payroll cost, comes from PPP Schedule A, line 10, okay? So let's go to PPP Schedule A, line 10. Okay, sorry. Okay, PPP Schedule A. Now this form determines your payroll costs. This includes all of your payroll cost information. Doesn't include anything else. None of the other covered costs are included on this form. This is all payroll costs. And you can see from all these yellow highlights that these numbers, all of these numbers are coming from the Schedule A worksheet, okay? You see Schedule A worksheet for almost every one of these items. So let's go to that Schedule A worksheet, and I'll briefly walk you through that Schedule A worksheet. And remember, this Schedule A worksheet is not a document that you are required to provide to the banker or to your lender. They're going to ask for the supporting information, so we're going to recommend that you give it to them, and so provide as much information as you need to show your numbers and to prove out your payroll information. But this is not required information that you would give to the lender. Again, this is PPP Schedule A worksheet. Okay, it's a little bit confusing when you first look at it, because these boxes, they look, what's the difference between Table 1 and Table 2? Well, Table 1, you'll note that Table 1 includes compensation from the borrower for anybody who makes on an annual basis less than $100,000 a year. Table 2, alternatively, includes all employees that make more than $100,000 a year. So, you're going to have schedules that supports this information, and you're going to have to break it down between less than 100,000 and more than 100,000. Okay, so let's just go through this schedule real quick. Very simple. You've got the employee's name, the last 4 digits of the employee's social security number. You have the total cash compensation paid for this individual. And I have a note here, this cannot exceed more than $15,385. And actually, if it comes to $15,385, it should actually be on Table 2, because that's an annualized basis of $100,000. And this is only cash consideration. This does not include any insurance, whether it be health insurance, any other type of medical insurance, and it does not include benefits. That's included somewhere else. You can see here what you would do, the cash compensation for each of your employees, you add it up, and this reference to box 1 is the schedule we were previously on, okay? This section here is your full-time equivalency calculation. And if you remember when we were talking about the FTEs, you have to do an FTE calculation for all of your employees, okay? And then, and as you know, you compare that during the covered period to the base period to determine if you had an increase or a decrease in your FTEs, okay? So that's Table 1, and you can see box 1, box 2, box 3. I don't have anything in this section here on the salary wage reduction that Michael talked about. I just assumed for now that we did not reduce salaries in this example. So moving down to Table 2. Again, this is for employees making more than $100,000 a year. The tables are very similar. The only difference is you don't have the salary wage reduction test down here. And the reason you don't is because you do not have to do that test for employees that make more than $100,000 a year. And you can see here, you got box 4, which is reference to the previous schedule that I showed you, and box 5, which is reference to the previous schedule that I showed you. Down at the bottom of this form is the FTE reduction safe harbor. And this, we refer to this as the cure. And the cure being that if you had a reduction in your staff levels, and Michael talked about this, if you had a reduction in your staff levels, but you cure that by June 30th, if you cure that by June 30th, then you don't have to do any of these tests. These tests are irrelevant. And in my example, just in this example, at the beginning of the period, we had 2.5 employees, and there's a testing period here. You can see the date here for the testing period. We had FTEs of 2.5, and basically that's 2 full-time people and 1 part-time person. During the covered period, we had 3 employees. So we actually increased our FTE count, so we qualify for the safe harbor, so we wouldn't have to do that calculation. Okay? So like I said, these numbers tie right into the schedule we were looking at before, the payroll schedule, as I call it. Here, again, back to my payroll schedule. This includes my payroll costs. And you can see here, Schedule A worksheet, Table 1. It comes from Box 1. That's the 12,000. That's the total wages, total compensation, total cash compensation paid to people making less than $100,000 a year annually. This is the full-time equivalency for those employees. This would be the salary reduction calculation if you had one. And this would not be a ratio. This would actually be a number. And Michael talked about that a little bit. Okay, PPP Schedule A worksheet Table 2. Again, this is for the employees who make more than $100,000 a year off that other schedule we looked at. This is the full-time equivalency figure. And then, so that's the total payroll costs with the exception of our owners. Lines 6, 7, and 8. Line 6 includes your employee health insurance that you paid for your employees. Line 7, the employee retirement plan payments that you made for your employees. And then total amount paid for employer state taxes. We believe Pennsylvania unemployment would be included there. So you'd have an additional amount here. I didn't have anything in here for my example. Okay. Now this section here, line 9, I have it circled because it's very important. Compensation to owners. So that includes total amounts paid to owner employees, self-employed individuals. That's important. If you're self-employed individual and you don't have payroll, you don't have anybody on payroll, then this line would be included here. If you make over $100,000 a year, it would actually be $15,385. That's the annualized amount. None of these boxes would be filled out because you don't have any employees. So the only thing you would have, and a couple of you self-employed individuals out there, I know you're listening to me here. This is what you have. This is what you would fill out here. It just says $15,385. You would carry it to the other schedule. Okay, so line 10, payroll costs. All you're doing is you're adding everything up, adding all of your costs up, which includes the cash compensation paid to people making less than 100, the cash compensation to people making more than 100, and your benefits, health insurance, retirement plans. You total that up, $50,749. Your FTE calculation would be done here. In my example, I'm assuming we did not reduce our head count, so we don't have to do the FTE calculation, and that's what this checkbox is. I will tell you that this entire PDF of what you're looking at, Carissa will post it to our website after this seminar, so you can go in and look at this in more detail. And I know I have some, I won't call them mistakes. I have some things on here that I'm just showing for effect, knowing that may not exactly tie to an actual situation, but I have it on here just for effect, so I can show you how to complete this form. Okay, so you recall that this 5749 just came from that attached schedule, that Schedule A that I was just on. So these are our total payroll costs. And then we add our other covered costs, including business mortgage interest, business rent and lease payments, business utility payments. Okay, you take these amounts, come down to line 5. Line 5 would be the salary wage reduction that Michael talked about. In my example, I don't have any because I didn't reduce my wages. Add all these items up. So my total amount spent, my total covered costs were $67,164. And it's at this point that I need to consider an FTE reduction. If I reduced my employee count, let's assume that I went from 10 employees down to 8, then I would have a reduction here. Okay, and in that case, I would have my ratio would be 80%. I kept 80% of my employees, so this would be 0.8 in my if in that example. So this would be 80% of that number. In this particular example that I use for the example here, I'm assuming I did not reduce my FTE count, so I'm at 100%. So my total modified 67,000. So then a couple questions here. My PPP loan amount 67,000, which it's up here in the top. It's the same number. The payroll cost, the 75% requirement. Here's where you do the 75% test. And what you do is you take the total payroll divided by 75%. And it comes to 67,665. So for my example, I actually spent about 76% of my total costs were on payroll. So I do not have a limitation because of the 75% test. And then the total forgiveness amount, simply you take the smallest of either 8, 9, or 10. Okay. So my forgiveness amount would be 67,164, which is the same amount of my loan. And the reason I'm able to deduct, or I'm able to exclude 100%, is because at least 75% of my covered costs were related to payroll. Okay, so that's kind of just the application. Let me walk through a couple different sections here. After this application form, the next page, representations and certifications, and whoever signs the document, whether it be an owner or an officer, needs to go through and understand and read these, and you're certifying by putting your initials next to the name, that the dollar amount for which forgiveness is requested, and you see the bullet points. And you're also certifying that, one, it doesn't exceed more than 8-week period, 8 weeks worth of compensation, which is interesting considering that thing we talked about before, paid versus accrued. So that's interesting. And then you have some other certifications here. Obviously, everybody's going to read these. And like I said, this document will be online after their presentation. So going down through, go down to a couple different things here. I want to talk about one more small thing before I turn it back. A lot of instructions here. And then, let's see here, page 10. Okay, page 10 talks about what you're required to provide to the lender. Documents that each borrower must submit with its PPP loan forgiveness application. Obviously, the PPP loan forgiveness calculation form, which is in this PDF, the PPP Schedule A, and then all of this information has to be provided to the lender. Payroll information, including 941 information and other stuff, and non-payroll information. Like I said, this is on our website. You can go and look at some of my notes that I have in here if you have any questions. And obviously, if anything pops up as we start to dig through this, please feel free to call us. And Bob, you should be able to have access to the screen.
We'd like to bring this home with just a couple more comments. The first thing that I would tell you is, unfortunately, and I know a lot of you are asking questions, we have 85 questions and no time left. Unbeknownst to my partner Don and Michael, I have my good friend and partner John Yannick sitting here, who suggested that we complete a GYF FAQ for our website. And I think that's a great idea. So for those of you in the audience, we'll take every single question and we'll answer it through the weekend. I'm sure my tax group will be happy to hear that. And we'll get those questions answered and posted on Monday afternoon. But Dawn and I will need time to review the answers that everybody puts together to make sure that we're in agreement. So it'll take us until late Monday to get them posted, but we'll post the answers to every single question. I just want to talk about a couple more things before we turn it over. The first thing is, last week before we get to that, last week when they issued that final guidance, there were two things that were provided. There was a set of guidance, if you will, for PPP loan holders who are going to be applying for forgiveness. And that was about 20 pages long. And we've covered most of the relevant, important elements in this. But there was also another document there that was meant to provide borrowers and lenders with an understanding of what the SBA can look at and what the lenders can look at. And it goes into a fairly significant detail. At the end of the day, the SBA can look at anything it wants on any size loan. So there's been a lot of discussion in that FAQ 46 we talked about, said that there's a safe harbor for loans under $2 million. And generally that's going to be the case. And I think the audit risk attached to those loans, examination risk later, is pretty minimal. But that doesn't mean that the SBA won't be looking for abusive situations on a random basis to identify instances where there may have been abuses. One of the things that's of concern to me and Dawn is that the period for which they want you to hold on to these records is 6 years. 6 years has, under tax law, generally been limited as a statute of limitations periods for criminal matters. 3 years is generally the statute of limitations for civil matters. So it tells me they're going to hold this open for a much longer period of time than you would normally see for a tax return. Be aware of that and prepare your information that Dawn was talking about to back up your application carefully and completely so that you have those elements of information that you might need if it's ever challenged. Finally, the other things that we have here, forgivable loans are excluded from I'm not sure what that means, Dawn, to be honest with you. These loans are not excluded. Any portion of the loan that is excluded, any portion of the loan that is excluded is not included in federal income. That's what we meant there. I apologize. But the deductions, on the other hand, currently are not deductible. So it's almost a wash, if you will. We talked a little bit about independent contractors and self-employed taxpayers. We talked about PPP loans last time. And Dawn's talked about what the forgiveness is. So the couple minutes we have left, I want to talk about this legislation that was passed yesterday. And this is referred to as House Report 7010, is introduced by these two guys, Chip Roy, Republican from Texas, and Dean Phillips, Democrat from Minnesota. This has huge congressional support on both sides of the aisle and in both houses. So what you're going to see is a very fast turnaround on this. I would be absolutely shocked if this weren't passed by next Friday as well. So this makes some significant changes. And if you go to our website, we have we did a slide yesterday or the day before when we knew this was coming, but yesterday we had the actual bill. So to give the attendees on the call an understanding of what's in there, the bill that was passed by the House by a vote of 417 to 1 includes an extension of the 8-week, 56-day covered period in the original legislation to 24 weeks or 168 days or December 31st, 2020, whichever is earlier. So it significantly expands that, and it should make compliance with any spending levels on covered payroll and covered non-payroll easy to meet. The movement of the date for rehiring employees that have been furloughed or laid off due to the economic implications has been moved from June 30th to December 31st in that bill. So Michael talked about the rehiring of people that were let go for economic reasons and the way that works to help you get greater loan forgiveness. That dates back 6 months. The 75% covered payroll requirement that the SBA put out in one of their earliest communications has been lowered to 60% congressionally in this particular act. An expansion of the payback period for the loan amount that ultimately is not forgiven. Everyone on the call will recall that the original terms were that any amounts that were not forgiven would be a 1% loan for 2 years. That's moved to a minimum period of 5 years, so the payback's much slower. An extension of the original 6-month deferral. Obviously, you borrowed these loans. Nobody has been worried to date about paying the interest or principal or the fees associated with those loans because they were standing by to get forgiveness. But that period was originally deferred for 6 months. Now it's 12 months. So that deferral period is a lot longer as well. A relief provision that allows for the FTE determinations to be made in a more favorable means to you as the borrower. A provision in that particular statute yesterday that the application for loan forgiveness has to be made within 10 months of the last day of the covered period. Now, remember, the covered period is likely to be it's going to be greater than 8 weeks. It may not rise to 24 weeks, but that's where it's at. And then there's a very important change in there that's been promulgated, that there was a provision in the CARES Act that said if you took a PPP loan, there was another economic incentive in the CARES Act that is not SBA related. It's IRS Treasury related. And that particular provision allowed for the deferral of the payment of certain payroll taxes, essentially the employer's share of the 6.2% FICA tax. So the employee, of course, will still, have that amount withheld from his pay, but the employer doesn't need to pay that tax in from March 27th through December 31st, 2020. And that amount will be owed to the IRS if you take that step to move forward, but 50% of that will be paid on December 31st, 2021, and 50% will be paid on December 31st, 2022. So in effect, it's an interest-free loan, and the way the constructs are of that particular statute, you can actually reduce all payroll contributions to an amount that basically looks like what you can expect to be the employer's share for the year. So in other words, you can get in advance on those amounts by taking federal withholdings and other Social Security taxes and not paying them in so long as it doesn't exceed what your employer's share of your Social Security tax liability would have been at the end of the year. Again, that will be payable later, but the idea is to help businesses who are suffering through difficult cash flow circumstances to hold on to some of their money for a little bit longer period. I'm sorry that we've run a few minutes over. It seems that's the case every time we get together. I would have thought for sure that we could have done this in a nice webinar in 90 minutes the first time. Now we've done 90 minutes the second time, and with this legislation pending, it looks like there'll be a third call as well to finalize things. The prognosis for this bill is very high, so we would expect changes, as I said, in the next 10 days. We appreciate everybody's attendance. I will talk to Don after the phone call. He may be choking me. It's a good thing we're at a distance, but I think getting these answers on the website is the quickest and best way to communicate with all of you. And we'll not only answer these questions, which are now up to 95, but we'll also answer any questions that remain from the last seminar as well that aren't included in these particular questions. Thank you all. We really appreciate you listening today and joining us on our phone call, on our webinar. We hope the information that has been shared has been helpful and of some benefit to you. Please understand and know that anybody at Grossman Yanni Ford, but especially Don, Mike, and myself are available and welcome any questions on this and would be glad to help anybody out. So our contact information is there. Feel free to contact us if you can. And you might have to nudge me a little bit. We are pretty pressed with all of this, but we'll get back to you as quickly as we can. Thank you all. Stay safe, stay 6 feet apart, and enjoy the weekend. Bye-bye.